How's it going, traders? In this video, I'm going to be going over how you can find your daily bias in the market in a simplified way. We're not overcomplicating anything. So before we get into it, I want to give a big shout out to TTrades for teaching this concept. However, I've simplified it down to my own personal understandings and experience with the market. And this, in my opinion, is the simplest it can get. Now, we're only going to be using one PD array, which is the old highs and lows, also qualified as previous day high and previous day low. We're not going to be using fair value gaps. We're not going to be using order block, and we are only starting from the daily chart. So here is what we'll be covering in this video. We're going to be going over daily bias, and we are also going to be discussing about a protected swing and failure swings and how to spot them in real chart. We're going to be talking about candle body closures, and most importantly, we will discuss the key relationship between them and how you can use them to find your bias in your day-to-day trading. And then I will show you how it looks in a real chart example. So enough yapping, let's get into it. What is daily bias? Daily bias is your directional expectation for the day based on how the previous daily candle closed in relationship to its surrounding structure. And in other words, your daily bias is simply your anticipated direction for today based on yesterday's candle. Think of it as your foundation. Before you drop down to the intraday chart, you need to know if you are expecting a continuation higher, a reversal lower, or maybe it's a day where you just sit and watch price action. Now, take a look at this PDF above. In this first example, we have a bullish continuation where we could expect the price to reach for the previous day high. And the second example shows a bearish reversal where we could look to target the previous day low. And lastly, we have an invalidation, which in this case, we sit and watch price action because we did not react to either the previous day high or previous day low. And in a case like this, we cannot tell where the price would want to reach out to first. Now, the way we figure this bias out is by reading yesterday's and previous days price action using three simple tools, which are protected swing highs or lows, failure swing highs or lows, and a candle body closure. Once you know how to read those three, you will always be able to classify today's bias into one of three outcomes, which are continuation, reversal, or invalidation. So first, let's get into the explanation of these three tools so you can understand how it works and related to each other. So a protected swing high or low is simply a swing point that we expect the market not to revisit in near term, and it is confirmed when price creates a clear space between that swing and the current price action. Most of the time, these protected swings form as the highest high or lowest low in a trend, and usually they've already cleared some liquidity before price continues in the opposite direction. So why does this matter? Well, because once a swing is protected, it becomes a level we expect the market to respect until the next liquidity target is reached. In short, in a bullish environment, a protected low should not be revisited, and in a bearish environment, a protected swing high should not be traded back into. Now, check out this example from this PDF. Here, we've got a protected low, and why do we call it protected? It's the lowest low in the current price action. And second, it cleared out old lows to the left. And lastly, there is a clear space between that low and where price is currently trading. So if the next daily candle is about to open, we don't expect it to come all the way back down and make another new low because the liquidity has already been taken out. Instead, we anticipate price to respect the protected low and leave space between it and the new candle. That's what qualifies the day ahead as a potential bullish continuation. Now, the same logic applies in a bearish case, just flipped over. If we get a protected swing high, it's usually because price already cleared liquidity above prior highs and marked the highest point in the current price action. From there, we expect that high to hold and not to get revisited when the new daily candle opens. So the key takeaway here is this: if yesterday left behind a protected swing, today is more likely to respect it. A failure swing high or low is the opposite of a protected swing. Instead of being a level we expect to hold, it's a level that's vulnerable, meaning price is more likely to target and take it out. You can usually spot a failure swing when multiple highs or lows form very close together. This shows up as equal highs or equal lows, and that cluster of levels becomes obvious liquidity sitting in the marketplace. And why do we call it failure? Well, because the swing failed to push price far enough away to create space. Instead, price stalled, left those equal levels behind, and now they act like magnets. The market loves to run that liquidity before making its real move. So here is the simple way to think about it. In a bullish environment, a failure swing high or equal highs is likely to be taken out. And in a bearish environment, a failure swing low or equal lows is likely to be taken out. So whenever you see a cluster of equal highs or lows, don't expect them to hold. You expect them to get traded into. A candle body closure is the final piece that confirms your daily bias. And here is what it means. When a daily candle closes, we are not just paying attention to the wick. We are focused on the actual body from open to the close. That closure shows the market's true intention for the day. So how do we use it? If the daily body closes above the previous high, previous candle or swing point, that's a strong confirmation for bullish continuation. And if the daily body closes below a previous low, previous candle or a swing point, that's a strong confirmation for bearish continuation. But if the candle fails to close beyond those levels or closes back inside the previous day's range, that signals indecision or often set up for a potential reversal. So I want you to think of the body closure as the stamp of approval on whether yesterday protected swing or failure swing logic is valid. And without that closure, your bias is shaky, and with it, your bias is confirmed. Alright, now that we've gone over the three tools, protected swing, failure swing, and body closures, let's put them together, because once you know how to read those three, every single day in the market is only gonna fall into one of three possible outcomes, which are continuation day, reversal day, or indecision, also known as invalidation day. Now, continuation day is when the trend simply continues in the same direction. We usually look for this after a protected swing has been set, because that gives us the anchor to trade away from. And in this first example, yesterday left a protected low, so we anticipate this next daily candle to continue higher and trade to that previous day high, and that's a bullish continuation day of previous day's range. And the reversal day occurs when price runs above or below a previous day's high or low or old swing but fails to stay above it. Instead, it rejects and closes back inside. In that case, the market may have just grabbed liquidity at that level and now it's ready to shift direction. When this shows up, that's when we lean on intraday narratives to confirm the reversal move and also find the trade opportunity inside of this daily candle. The last, which is the invalidation day, sometimes the market just chops around, and if today fails to close beyond any key levels, or maybe we run both sides of the yesterday's range and closes back inside, there is no clear continuation or reversal. And here is where discipline comes in, because sometimes best trade is no trade. So now here is the key relationship between protected swings, failure swings, and body closures, because this is really what brings the whole bias together. And here is the formula in simple terms. Protected swings give us the level we expect to hold. Failure swings give us the levels we expect to get run. And candle body closures tell us whether the expectation is confirmed or rejected. The key relationship in this is that protected swing is our anchor, failure swing is our liquidity target, while the body closure is a confirmation stamp. When you blend those three together, you've got a clear and consistent way to classify any new trading day before you even touch the intraday charts. Alright, let's walk through this step by step. First, we put in a protected high, and it's protected because price ran liquidity above the previous day's high and printed the highest point in that cluster. After that, we don't expect it to be taken out again in near term. So price then traded away from that high. Looking left, you can see multiple failure swing lows, each prior candle left its low intact and pushes higher, that creates equal low, which is weak liquidity the market is likely to target. So with a protected high in place, the expectation is for price to run those failure swing lows. And that's exactly what happened. Price swept the low and formed a protected low. And why is this low protected? It cleared the failure swings to the left and held as a stand-alone low. Notice the daily candle closed back inside the previous day's range instead of closing below it. That confirms a bullish reversal day. So from here, we expect the next candle to continue higher, targeting the previous day's high and any nearby failure swing highs. And as you can see, the reversal candle left a failure swing relative to prior high. And here in this second example, price first formed a protected high after running above the previous day's high. To the downside, we had a failure swing lows, and none of those lows took out the prior low, so they are vulnerable liquidity targets. And on the upside, we also had a failure swing highs. The very next candle swept those failure swing highs and then closed back inside the previous day's range. That confirms a bearish reversal day. And with that protected high in place, we expect the following candle to continue lower, aiming for the previous day's low and the cluster of failure swings lows beneath it. So alright, enough theory. Let's jump into the live chart and see this play out in real time. On the daily chart, the first question you want to ask yourself is this: based on how previous daily candle closed, is the high or the low a protected swing or a failure swing to any highs or lows to the left of the chart? Because this gives us the first clue of what we should expect the market to do next. So in this first example, if we look at the previous daily candle, we can see it closed as a strong bullish candle. Now, in this case, the question is this previous daily high a failure swing to any highs to the left of the chart? And just because it's closed bullish? And the answer is yes, because this previous daily high is a failure swing to this old high on the left and also to this other failure swing or equal highs. So going into the next daily candle, I'll be anticipating a bullish continuation towards the previous daily high and potentially towards those failure swing highs to the left. Now let's see how that plays out. And as you can see, price ran above the previous daily high and even closed above it, but those failure swings high to the left are still intact, so that remains my main objective. Going into the next daily candle, I'll be expecting for bullish price action until those failure swings are taken out. Let's see what happens next. And as you can see, price took out those equal highs but could not close above them. But notice we still closed above the previous day's high. So in this case, I will continue to anticipate a bullish continuation in the next daily candle. Now let's see what happens. And as you can see, we ran above the previous day high again, but this time we closed back inside the range. This signifies a bearish reversal day because liquidity was taken above the previous day's high and then price closed back inside. And also notice this is now the highest high in the current price action. So I'm viewing this as a protected high that should hold. And at this point, I then look to the opposite side of the chart and ask, is this previous day's low a failure swing to any low to the left? And the answer is yes. If you look closely, this previous day's low is a failure swing to this old low because they are in close proximity. So in this case, my bias going into the next day will be bearish. I will expect price to take out the previous day's low and potentially this old low to the left as well, since they are close together. So let's see what we got. And as you can see, price swept those lows but then closed back inside. That closure signifies a bullish reversal day. We also just formed a protected low right there, so I'll be anticipating the next daily candle to trade away from that low, meaning I will expect a bullish bias for the next day. Now let's see what happens. And as you can see, price ran above the previous day's high and closed above it. Again, we ask the same question. Is the previous day's high a failure swing to any high to the left? Yes, this high is a failure swing to this old swing high. So I will anticipate that the previous day's high and this old high will both get traded into. And as you can see, price went ahead and took out that old high. Let's get into one more example. So in this second example, we see price printing a very bearish daily candle. Again, the first question we want to ask ourselves is this low a failure swing to any lows to the left? And in this case, the answer is yes. This low is a failure swing to these old lows to the left, and they are also equal lows. So going into next daily candle, my bias would be bearish, expecting price to reach for the previous day's low as well as those equal lows to the left. So let's see what happens. As you can see, price traded lower, ran the liquidity below those lows and previous day's low, but then closed back inside the range. That signifies a bullish reversal candle. So now I'll be anticipating the next daily candle to be bullish, targeting the previous day's high and also old highs to the left. Let's see what we get. And as you can see, price ran above those highs and closed above them, confirming a bullish candle. Going forward, I'll be expecting the next daily candle to continue bullish, reaching for the previous day's high and old highs to the left. Now let's see what happens. So price does run above the previous day's high, but then closes back inside the range. That makes this a bearish reversal day. And this is exactly what I mean when I say if you want to trade this kind of candle, you need to lean on your intraday bias for confirmation. But since this series is focused on daily bias, we will cover intraday confirmation in a later video. So for now, let's stay on the daily framework. So looking again, this bearish reversal candle closed strong, and we ask ourselves, is this previous day's low a failure swing to any lows to the left? Yes, this low is a failure swing to these equal lows. So my bias for the next day will be bearish, expecting price to run below the previous day's low and into those equal lows to the left. Let's see what happens. And as you can see, price ran below the low and actually closed below it. So I'll still expect bearish continuation going into next day. Again, we ask ourselves, is the previous day's low a failure swing to any lows to the left? Yes, we still have equal lows sitting there. So my target for the next day will be those failure swing lows. But as you can see, price did not reach them. Instead, it closed back inside the range as a bullish candle. So because of that close back inside, my expectation shift back to bullish for the following day, looking for price to target the previous day high. Now let's see what happens. And as you can see, price ran above the previous day high, but closed back inside the range, giving us another bearish reversal day. So again, we ask, is this previous day's low a failure swing to any lows to the left? Yes, we've got equal lows sitting there. So my bias going into next day is bearish, expecting price to reach the previous day low and potentially those failure swing lows to the left. So let's see what happens. And this time, price finally ran through those lows, taking out the liquidity. So as you can see, this framework plays out in a very structured way. It won't always be perfect. Sometimes the market will fake you out or chop around. But the point is, we now have a clear and consistent way to build our daily bias. So instead of waking up every day confused about what direction the market might go, all we are doing is asking one simple question. Based on how yesterday's candle closed, do we have a protected swing or a failure swing? And from that one question, we can map out whether to expect continuation, a reversal, or just indecision. And once you start practicing this, you will notice how much easier it becomes to filter setups, manage expectation, and stay disciplined, because you are no longer chasing moves blindly. I highly recommend you backtest this yourself. Go through charts, candle by candle, and apply this exact process. Ask the question, mark your bias, and then see how the next day played out. Do that consistently and you will build a confidence in reading price action this way. Because once you understand the daily framework, everything else and the intraday confirmation, your entries, risk management, all becomes way clearer. And moreover, traders who actually practice this are the ones who start seeing the market clearly, day by day, candle by candle. So that's how the daily framework, also known as daily bias, works. Simple, structured, and consistent. And if you find this breakdown valuable, do me a favor by hitting that like button so more traders can find this, and make sure you subscribe if you want to keep building step by step with me. So stick around, subscribe, and let's keep building together. I will see you in the next one.